Okay, hello everyone. Welcome to Market Insights. I'm David Russell, VP of Market Intelligence here at TradeStation. Wanted to welcome you guys here. I do this every other week, and we're just changing a few things. So at this point, I want to just show you guys these disclosures, but also want to let you know that we're going to be moving the zip files and stuff. Most of you guys probably have the zip files I'm using right now. So if you do not, then I would simply ask you to please email me. I'm going to share my email, and we're moving the location of these. So erussell@tradestation.com. We have a disclosure page for ETFs if you're interested in seeing those. And like I said, in about 2 to 3 weeks, I'm going to be starting to do a webinar every Thursday. And that way, we're going to have all the zip files in a new location and stuff. So if you just bear with us a little bit longer, but again, if you're unable to see any of the things that I am working with now, this workspace, please email me and I will provide it to you. All right. So we have some interesting things here as the market kind of sits in a very interesting range, kind of a pregnant moment, you could say. So let's actually look at, starting off where the S&P actually kind of is here. I'm going to use two workspaces. First is going to be, I'll start off with the ES charting. So ES charting is one that is in the zip file I've given you guys, and basically there's a few things to look at here. What's interesting to me is we can see a basing pattern here, and the question is this a basing pattern, a higher low versus October, or is this a bearish flag consolidation with new lows, or at least a retest of the recent lows? There's a few things that are interesting to me. If we go here to drawings, and then we go to Fibonacci retracement lines, and we go from this low to this low, we're looking at it pretty much a 50% retracement that we're trying to hold. So that is something that's potentially bullish. It's also interesting that we made a low at the very beginning of the fourth quarter. We're trying to make a higher low here. Both those things are kind of interesting. If we switch this to the daily chart, we can actually see as well that there is a low from right here in May that we're trying to hold. Now, it doesn't mean that the market is going to rebound. What it means is that we're sitting at a level, and it can go either way. And so I think what's interesting here is the VIX. I'm going to get to the VIX. I want to just mention a few other things first. Let's actually, I'm going to change this very quickly to ES, and then I'm going to go back to an hourly chart with no studies or anything. So I want to kind of to show you what's kind of happening here is if we do some trend lines, you can see that there's something of a triangle forming. And one of the things I've learned when I really started trying to trade was, if you think you see a triangle, you almost always are seeing a triangle. And it's a good way to get frustrated, is to when you ignore them. So I mean, being overly bearish here is a good way to get frustrated, as well as being overly bullish. So we have a triangle squeezing here. Now, another thing to look at is, let's look at the VIX. Go back and let's look at a daily chart now, the VIX. A lot of people have noticed with the VIX that it keeps bouncing at 20. And we're back down to this range trying to bounce. So what kind of stands out to me is, at this point in time, if you're bearish, it's an interesting time to think about having puts. Puts that have a higher vega, which tend to have a longer period of till expiration. Those have a higher vega, which means they have a higher sensitivity to volatility moving higher. People in this situation, this is an environment where it's potentially interesting to think about buying puts that might actually be a little bit unusual. If you look out in time, if we go to Option Station Pro, this is not a recommendation. This is something that I've noticed as a pattern, and I know some, some people who I used to work with would trade these. And it's an interesting approach to using the Greeks in your favor. So now this is Option Station Pro. Let's look at SPY. And now let's shrink this down. Make sure, in this case, you want to make sure you have Vega here, and you do that by going to the handle, the wrench thing, and going to customize columns. So Vega tells you basically how much your price is going to change, your premium is going to change based on changes in volatility. Now, VIX is similar to the implied volatility S&P. I mean, there are technical differences, but essentially the same thing. So if you look out, for example, at something like December of 2023, and you look at some of these, you'll notice that the Vega on these is over like 1.4. And then if you look out to something like, the current monthlies, the Vega is 31. So you can see here that now, of course, these are much more expensive. So one strategy I've seen people do is to own puts that have a high Vega, but a much lower delta. So these puts are really at the money, which is why they're so expensive, and they have a lot of delta. So the problem with these is if the S&P rallies, then basically you're going to get hit on the delta. But if someone were to go far out of the money to the downside, way out here. So right now the lowest strike is like the 270s. These have much less. Wait, I'm sorry, I was looking at calls, but the puts, the Vega is gonna. I mean, the delta is gonna be similar. The key thing is if you look at these, the delta on these is much lower. So if you look near the money around like 380, look at the delta. We have like 42 deltas, but if we go down here, we have like around 10 delta. But you have something like 67 to 70 Vega, which basically means if the VIX were to pop, say the VIX goes up $1, then these puts will go up by something like 63 cents, and they currently have theoretical price around $6. So these would appreciate more quickly. But the thing is that the S&P rallies, they're not going to lose very much value because they have such a small delta. So this is a strategy that's something of like a hedging approach. And the thing is if you buy puts that are near the money and the market goes against you, you have the cost of those puts can work against you. So just something that's kind of interesting here, because what's interesting to me is the fact that we have essentially a situation where the VIX is holding this long-term level, and it's really interesting to see where the market is now. It seems to me like one of two things can happen. The market can tank and just crush to new lows and VIX flies. And another possibility is the market rallies and VIX goes under 20 and bullish things and the market sentiment starts to change more positive. That's really where we are now, and it's an interesting sort of balance. I'm not going to try and predict one thing or the other, but it's really interesting to me to see VIX sitting at this level as the S&P also consolidates in this tight range. The other thing is we're the beginning of a new year, and the question is when you're in a new quarter and everything else, sometimes you see different kinds of sentiment. I mean, last year, as soon as the year opened, we went from being complacent to being increasingly fearful. So I wanted to just kind of point that out. This is an interesting moment. And what's interesting also is that, if this turns into a bearish flag, we're likely to see an acceleration of VIX to the upside and a bunch of momentum sellers to the downside. And, maybe that's what we see. And in many ways, it comes down to tomorrow's non-farm payrolls report. Today's ADP report was better than expected, which is not good for the market. And we saw some other things that there are two other, well, initial jobless claims were also lower than expected, which is positive for jobs, but also bad for the market if you're hoping for the Fed to slow or to pivot. And then there's also something interesting. We look back, the November trade deficit was much narrower than expected, which is going to be positive for Q4 GDP, which is an interesting sort of thing to pop up. I'm going to get to that in a second. I want to just look at the other workspace we share. So I'm going to put this back now to time frame hourly. And the idea of this is, I'm going to remove this Fibonacci retracement as well. The idea of this is the cash index. This is interesting to see levels on the daily, and this is the hourly. And basically what we look for here is we look for signs of trend with the 50-hour moving average, MACD, and overbought, oversold. And right now we have an oversold, which is a bullish indicator. The 50-hour is falling and MACD are falling, which are bearish indicators. However, when you look at the apparent triangle that I pointed out before and everything else, trend-based indicators like MACD and the 50-hour moving average might be less important than your oversold. So from my perspective here, it's pretty interesting. If you look at trend line, there's a trend line coming right across here, and we're holding that here. So it could be interesting to see if maybe the lows of the day have already been achieved. Let's look now at market breadth for masterclass. It's other workspace I have. Remember, if you guys have any questions, put them in the chat. It looks like all you guys have the zip file. Thank you for bearing with me on that. So this is the S&P compared to the RSP. The RSP is the equal weighted S&P 500. And what's interesting about this is when RSP, which is the white line here, is outperforming SPY, it means that breadth is improving. So in this case, the bearish relative strength is actually a positive, because it means that that you have positive performance by the smaller companies and a broader participation to the upside. I could actually change this chart around. It'd be interesting to kind of just, let's do this for a second to show you. So I do have here, if you look, I have two datas. I have data 1 and data 2. And you can see if I go to edit symbol 1 and 2, I have SPY and RSP, which show the white line is RSP, and then I have relative strength down here. But I could do something different because it might seem confusing. So what I can do is I can make I know why I did it now. I did it this way because I wanted to be able to see SPY for where it is. And that's the reason why. So we're using inverse relative strength. So just realize in this case, that's what we're seeing. Now, this shows improving breadth. If we look at the advanced decline line, we also see that this level here, it has been confirmed by the advanced decline line. So we're seeing more companies here. The advanced decline line is doing better. What's also interesting to me is that we're seeing the number of companies above the 20-day moving average moving higher. Very often, now these are two different indexes. The companies above the 20-day as a count, and the companies above the 50-day. Very often when the blue crosses over, it's a signal. So right here, for example, bearish signal. Right here, bullish signal. And here we're attempting a cross, but maybe we didn't get it. Yesterday we were darn close, and now we're literally like right at it. So that's interesting to see here. It also just kind of shows how much of a sort of pregnant moment we're in right now. All right. All right. I'm done with these two things. All right, last thing I want to mention is if you look over here at the radar screen, you also see our RSP, and you can see in recent days and months, RSP has really outperformed. Now we go over to our masterclass workspace. and we look at we go to price grid, you know what? Delete this and bring in S&P 500. If we look at the kind of the ones that are really doing worse, and we look at, for example, market cap, we can see that for the most part, we see just a lot of, the continued weakness in these big NASDAQ names, which I think is pretty interesting. And also the kind of continued weakness in NVIDIA, Tesla. This is really like where the pain is. But now we go over to our moving average tools. This has the MA above below, and we can see the companies above and below their the 50-day moving average. That was like over here, number of companies above. What's been interesting to me is to look at some of these companies that have been above the 50-day moving average. And I see a few different things popping up. One of them is that there has been something of a pattern of companies with Chinese exposure doing well. There has been a shift here that's been pretty interesting in terms of Chinese exposure, like Las Vegas Sands and Wynn Resorts. But there are some others. Nike has been extremely interesting, and I think a real under the radar name recently. Nike had a good earnings report based on North America being strong. People have been waiting for a long time for Nike to take off in China. So what's interesting now is their China numbers were not that good last quarter. This is their earnings report. But what's interesting is North America was strong. And now if the market is hoping of strength in China, then that's also something which is forming a little bit of a bullish pull on Nike. So I think this is kind of interesting to notice. Wanted to show you also, all right, another one is Starbucks. Starbucks hitched their wagon to the China trade, the Chinese consumer, a few years ago. And that was not a good thing for a while here. But here we have, once again, it had an interesting upgrade. I think it might have been Bank of America here. But this is also above the 50-day moving average. And, it'll pop up on this list. So what's interesting to me here is that there is a new set of companies, and I've said this a lot, but it's time, I think, to look. The market is trying to tell us stuff. And one of the things it's saying is we just are so tired of Tesla and honestly, Microsoft and NVIDIA. These are names that I know we all love them, but when you look at the price action in these, it's heavy. And the reason why it's heavy is because everybody owns them. There's no marginal buyers coming into these names. But when you look at the way Nike's been trading, what was this? This is a major low it's been coming off. The sellers were done and it's been moving higher. What's also interesting to me, and this, how crazy is this sounds, look at Ralph Lauren. Look at, I'm looking, I had a list over here, some names I looked at. Best Buy. Also above its 50-day. It's not as maybe not quite as dramatic, but what's interesting is there are some other companies here. I had a list here. Macy's was another one. These are all stocks that had some strong earnings reports. They've pulled back. And to me, it's interesting to see there's some others here too. Home builders, you can see right here, DHI, LEN. The one that really grabbed my attention was Ralph Lauren. But it's interesting here to see the home builders on this list as well. If you look at the ITB, which represents the housing index, also, this kind of tight basing pattern, it comes right back to their summer highs and they're holding. There's a series of stocks that are doing things like this, like Starbucks was. Actually, no, it was Oracle. I'm sorry. Oracle was another one that I looked at recently. Comes back to its summer highs, kind of consolidates, and pushes higher. There are stocks that are doing this right now. Look at where this is versus August versus Nvidia. This is a sign of the relative strength that is kind of emerging here. Ross Stores, who had a very interesting quarter. TJX, these are very slow moving companies, probably not as interesting for people who want to be trading actively. Alta Salon. But there are some others here that are very interesting as well. And one of them is a copper name like Freeport. Chinese exposure as well. FCX, this is one. And let's see if anything else popped up on this list here. I'm just kind of watching. You see Oracle. See, Netflix is interesting as well. I mean, this one is. It's also interesting. I mean, to me, we have a problem with the overall communications ETF, the XLC, which Netflix is in. We have a lot of concerns here about advertising and everything else. So for me, Netflix is in a tricky spot, but it also is interesting that this is a name that look where it was versus the summer. That's relative strength. So I'm just kind of looking down this list, and what's interesting to me is we can use these tools like moving averages and relative strength to see where people are looking for the next set of leadership in the market. And I wanted to just kind of point out that approach. Now, the other thing is KWEB, the Chinese ETF or the Chinese tech name. This is very dramatic. We had the interesting news about the Chinese regulators loosening up on Alibaba with their Ant Financial. And that is, also pretty interesting because it suggests that it's interesting in the last month or so, Xi has gone from being, kind of overly strict on stuff, kind of like a very authoritarian, to now he's letting COVID, run its course. And people might not like it and stuff, but the thing is that that's a pro market force. Now he's doing this pro market thing with Alibaba and Ant Financial. So, if China has had a kind of negativity that is just so broad, when you look at what Xi was doing, and then you look at the COVID thing, and if those things go away, you're looking at, look at this. I mean, you're looking at tremendous pullbacks. And the thing is we have to remember in late 2019, China had a bunch of stocks added to the global, to some of these global indexes. And that's one of the reasons why it had this enormous rally in 2020. It wasn't just the fact the Fed was, keeping interest rates low. That didn't hurt. But a big part of it was the fact that it had just been added to some global indexes here. So there's a lot of people who really like China. And, it's interesting when you think about it because, you have something there which is such a huge market. And you also have such a clear case of like an e-commerce based economy. The United States, you have all kinds of legacy stuff of old shopping centers and things where the narrative is not as clean, but investors love these Chinese technology stocks, and they had an absolute bloodletting for about a year and a half. And if the tide is turning in these, it could be pretty interesting. So I think this is something that we want to keep on our radar. Right now, if you look at this, it's back to some levels where there's probably some resistance and things, but this has been another interesting trend that's been happening for the last few months. And when you take a long-term view of it, there might be reasons for more optimism. All right. Is there a zip file? Please email me and I'll share the zip with you. I have to make sure. I'm not sure if it's still available where we had posted it. But D Russell at TradeStation, and I will share the zip. So the S&P here, it looks like people are looking out and seeing more bad stuff coming in terms of the Fed. It's interesting. let's see what happens here. Interesting to see if we get follow through to the downside before the news or not. Not really sure what to think. I do know though that triangles are maddening, and just realize that we're in one. Let's see. Those are most of the points that had really come up to me. I do think it's interesting, and I've mentioned a lot about what I see as the intrinsic strength in the US economy. And I think we've seen this more and more. We see it with with the November trade data. We see it with things like the ADP jobs report. And what's interesting to me is that the Fed, it's funny, the Fed has actually pivoted, but what they've done is they've pivoted from inflation to employment. And they've been all over the map. The bond market at the beginning of last year said you need to raise rates, and Jerome Powell said, no, we don't. And then, it was the bond market last year that moved first. Look at the 10-year Treasury yield. It was the bond market that said, we don't believe you. We think rates need to be higher. And it dragged the market higher. And now what's interesting is the question is, this lower high on the 10-year is kind of interesting to see. And I'm, from my perspective, when you look at a lot of the forces that have been out there, especially the decline in energy prices, the Institute for Supply, I mean, we keep seeing more and more evidence of inflation slowing. The Institute for Supply Management, their inflation gauge has been falling for 3 months. Now, don't forget that inflation thing that the Institute for Supply Management puts out, that spiked long before CPI back in 2020. That was spiking in like June and July of 2020, like a year before inflation. So there are a lot of things the market can see to be optimistic about and positive about. The question is simply, where is the Fed? And the Fed is this strange sort of government agency with their own internal politics. They really got stung by being wrong about inflation. And the question now is, do they simply refuse, have they been once bitten, twice shy? And they're going to just push and push and push. And it's a great kind of question because the market doesn't believe that will be the case. But at the same time, we've never been in an environment like this before. And what's to me interesting is that the Fed seems more focused now on employment. So they have this belief that unemployment needs to rise, which is strange because it goes against their mandate. But they somehow believe that unemployment needs to rise for inflation to go down. It doesn't necessarily make that much sense. We saw unemployment was falling before COVID and there was no inflation. But the Fed is fixated on this now. So the market on one hand sees reality, which is that inflation has peaked and that the Fed can stop raising interest rates. But then that is one reality. And the other reality is that the Fed is in such a point of confusion now that they are more concerned about a non-issue. And you see this when them talking about employment needs to, it was in the minutes. It was in what Paul was saying before. It was in the last summary of economic projections, where basically they were projecting higher unemployment. And that obviously scares a lot of people. But at the same time, it scares a lot of people in terms of people thinking that we need to have something more hawkish. Nonetheless, what have we seen already this month? We've seen job cuts from Salesforce and Amazon today. Goldman Sachs is going to be cutting jobs. So there's a lot of things here where even the labor market itself is showing, some anecdotal drift, in the direction where the Fed wants to go. To me, it's the real issue though is, and this is very difficult, because the market looks at reality and the Fed looks at a bunch of people sitting around a table looking at each other and then looking at the newspaper and trying to make sure they don't look too stupid. And that to me is really the thing now, is understanding the internal sort of dynamics of the Fed. They had models that said there wouldn't be any inflation, and they were wrong. Now they have models saying there will be inflation. And that's unfortunately the kind of confusing spot that we're in right here. The other thing that was interesting is I can't remember now what it was. I had some other points here. It was the well, we had those, I mentioned the layoffs, but at this point in time, it's interesting. The question is simply, does the 10-year, I think the 10-year is the leading indicator for all of this. And the other thing I was going to say was, talking about the dollar. The dollar has really been sliding recently. It's easier on TradeStation to look at euro dollar. So if you look at euro dollar here, this has shown some real strength. And what's interesting here, this was a very cool German inflation report. And the question now is, does this move back lower, or do we hold here and see more upside in the euro? So what's interesting to me here is that I have this other, let me show you, I have this other workspace I've worked with some. I call this one market regimes. You can create it yourself pretty easily. Basically, I look at, SPY, and then I use monthly with 3-month lagging. If you look at like EFA, which is the global ETF, these are really long-term trends. What you can see here is that the global has really been terrible since, it wasn't even just a financial crisis. It was this moment right here in 2009 when we started having, this was when the Greek debt thing happened. And then China right here started raising interest rates in early 11. And basically global has been horrendous ever since. But the point is, in some ways, is that if you look at something like European PE ratios are about 17 times versus 22 for the S&P 500. And I'm using the numbers from etfdatabase.com. If you look on that website, what's interesting is, for people, looking for valuations and stuff like that, there's been some data recently from Europe that's been very positive. So I just think it's interesting here to see that we are seeing this relative strength coming up in Europe at the same time when there seems to be some kind of ongoing buying in the euro. And I think it's very difficult to make a call one way or another on this. The thing, though, is that we are seeing some signs of strength coming back to global equities. And what's interesting is, when something's been bad for this long, what it means is there's not a lot of entrenched ownership. And then you see people shifting away from things like Tesla and Microsoft. So this is something I think we want to kind of watch. And, if we are near a point where the Fed, what I would say is if the Fed at this point in time is near the end, or when they are near an end, this is an area where people seem like they want to be owning stuff. And, we could enter a period here. You had the Chinese bullishness with the Chinese stocks. You see the EFA is mostly Europe. But when you look at this, these are showing emerging relative strength in your typical global thing. There was actually just today an upgrade of HSBC. Wait a second. This is my different workspace. Let's look over here. Look at this. I mean, it's just kind of interesting. I don't even know what's happening with HSBC. These Japanese banks had this huge rallies recently. What Japan was doing, their treasuries are interesting. So, to me, there's something happening in the global scene that is not getting as much attention as it should. When you look at the strength in, the gold miners, you get GLD, gold breaking 1800, not on this chart. If we look at the futures, 1800 was a really big level on gold here. You can see how it just fought its way through it. All these point toward a weakening of the dollar and a shift toward global. And if that's the case, like I said, that is just it's a new narrative, because global has been bad for the last decade. and there are signs of it turning around. So I wanted to just kind of point that out. I think it's something we need to kind of be aware of. And as the Fed moves toward the end of whatever they need to do, the global trade could be a place where money streams in for several quarters. I'm going to look at some of my other, yeah. One sec. I'm trying to look at some of my other notes. We had this thing when we had the You Can Trade, which is no longer operational. It's no longer running. I had a lot of items over there that would link to that. So we're going to be restarting these webinars in sometime in February. I'm going to do a webinar. I'm going to do an Art of Trade Station on the 18th, getting ready for earnings season. And then we're going to start doing a webinar on Thursday afternoons, shortly thereafter, late January, early February. And I'm going to kind of redo all the zip files and everything and have them organized in a new way. So I just, again, want to thank people for being understanding with that. We've had a lot of things of shifting from here and there and stuff like that. So thank you for bearing with us. I want to just see if I have any other notes that I might have. And I'm going to go through some of these workspaces a little bit more. All right, here's the other thing I wanted to just mention is that, if we have continued weakness in the dollar, that provides a certain kind of underlying bullishness to the market. That's the other point is that one of the problems for the market has been strong dollar has hurt earnings. If we see that reverse, then that entire process simply goes into reverse. So I think that's also an interesting sort of thing to think about. Like I've said, I see right now the American economy as being in a spot where we have jobs coming, massive job growth in the United States, really tremendous aggregate demand from business investment, but also the shortage of housing. This is to me very significant. And we're seeing with the baby boomers leaving the workforce and reshoring of jobs at the same time, it's creating a structural tightness in the job market that, if the Fed tries to fight that when they're missing the secular forces at work, then they're just gonna, I don't know what they're gonna accomplish. What they're gonna do is they're gonna cause a recession when we still have low unemployment. And there are structural forces right now that favor the job market. And the question is just, I mean, we could be in a bad situation where the Fed is shooting at the wrong target. And we have to realize they could do that. They could really make a mistake here. And the question is just, will they? And that's kind of the big question here. But I think it's important to realize that we are now have a structurally different market than we had, before the pandemic. And it's just different, and we need to adjust to that, see it being different. All right, and let's look at some other things. One other stock I wanted to just mention that's been interesting to me has been Flextronics. It's been an interesting company that is actually back. Let's go here to like our monthly. If you look at this, this is back now, breaking out from levels way back. This company has some. They've announced, if you just, it's nothing super interesting. They just have had a lot of changes in their business that have been very positive ways they've benefited from, jobs leaving, the redeployment of jobs in manufacturing. It's an interesting name that I wanted to just point out because it's been pulling up on a lot of my scans. It keeps popping up on the daily. It's pretty obvious breakout to 20-year highs, holding that 50-day moving average coming up. This is one we might want to have on our list. Another one is Box. Oops. BOX. Trying to form this sort of, trying to kind of consolidate here. This is in an area that is not great. It's basically e-commerce ad related, which is not great. But the chart is showing, it's trying to break out. To me, it's interesting that it's kind of pausing here. I think this is one that we might actually see kind of trying to hold 30 and a half for several months. And I wouldn't be surprised if we see it just squeaking higher. And then if market tone improves, we see some kind of acceleration. But it's interesting to see some of these tech stocks that are actually doing well, that are above their moving averages. So I wanted to mention that one. All right. Let's take a look now. I showed you guys how to find these stocks that are above like the 50-day moving average using this indicator, which is in the workspace you have. Let's look at some of the other things that are popping up here. We look for companies that are, for example, the 50-day moving average. This is actually one that was interesting to me. I'm not saying this is a buy here. But what's interesting is American Tower. This is like a long-term sort of, asset. There's a company that, there's a very limited, amount of places you can put cell phone towers, and this company, along with two other competitors, pretty much has monopoly on them. This is interesting in my view. Stock here that is, where it was in August of 2019. Excuse me. It's gotten really hammered by the hawkish Fed, but this is one that institutional investors like over the long term. There's a weekly chart if we go back to the daily, but this is one that was popping up recently for me to see this 50-day moving higher. Let's look at some of the other companies here that are at the 50-day moving average. We have Citi, which to me, this is a very sloppy sort of stock. I don't know what to make of this company. All the financials now are to me kind of tricky, because when you really look at what's happening, if we see more downside in yields, then those stocks are, the curve is going to invert and remain very inverted. So what concerns me now about financials is that all right, let's put it like this. Treasury yields need to move down or stay where they are, the long end of the curve, for the market to rally. But that's bad for financials. So from my perspective here, financials are like, there's so much bullishness packed into them right now because of their low valuations, their relatively low risk, and their, the fact that in a cyclical economy, this kind of unemployment, there's so many potentially positive things for the financials in the longer term. But in the next several quarters, or at least the next several months, there's so much negativity toward them because of the curve where it is and risks of a recession. So from my perspective here, we want to just kind of remember or think that the banks, when we get out of this and we get near some kind of Fed pause or cut, the banks have such dramatic fundamental reason to for people to be optimistic about them. And it's very significant when you actually look at the fundamentals of the banks. But it's one of those things where it's like it's just not ready yet. So I think we want to kind of bear that in mind. In my perspective here, the things that we're seeing now are more likely to favor this sort of global trade and a broad sort of, market upside. And, if we do move higher, and if we move lower, then obviously people are talking about recession. Those things are not good for the banks either. So I want to just kind of point that out, because I've been watching the banks and just trying to figure out. And from my perspective, they're just in a tricky spot because of the yield curve. Dexcom. This is one that's been interesting, but the problem with this company is it has a very high PE ratio, and that's been a problem for a lot of these companies. This company does diabetic treatments. I'm just kind of looking down this list and seeing other things that kind of pop up. MGM, interesting. That's a casino company. I think they have less Chinese exposure. So right now, from my perspective, the big question really is this triangle in the S&P, and what does it tell us? Are there going to be any sort of breakout one way or another. And from my perspective, focusing on that big index is really the thing that makes the most sense. If we have this, like a kind of concerted breakout to the downside, then a lot of these things don't make sense. But what's interesting is if we have a concerted breakout to the downside, then it'd be interesting to see what happens with names like, Lennar and these home builders, names like Oracle, which I did an idea on recently, names like Nike, because the relative strength in these, could put them in a spot where they don't pull back as much. They come back and hold a lot of these ranges, and then that can actually be the place where we see the leadership emerging going into, later in the year. All right, some of these things here I do with this price grid. Now we're in the masterclass workspace and we're doing price grid. And for me right now, none of these, this has not been something I've been using recently. So what we can do is we look at stocks that are, this shows you stocks in terms of where they are in their 10-day range. It shows you things that are kind of near their lows. These are all stocks that are near the bottoms of their kind of channels. Nothing here is very interesting to me. I don't see really much coming out of this, but this is how this indicator works. We look at stocks that are kind of near their levels. That's interesting. These are all things when you look at, and a lot of these are things that look like they're just kind of fighting up against uptrends, downtrends. You can see that they have the Keltner channels coming down at the top of the Keltner channels. So right now, individual stock sort of analysis is not showing me very much. I want to look at one other list I keep to see if anything else is popping up on it for me. Do I have a percent from 52-week low? I actually do. And honestly, look at this. If you just go to studies, edit this, all right, go to edit easy language. You can just copy this thing. All right, there's a thing called low 52-week. And if it does this blue color, wait, I don't want to change it. But if it does the blue color, it means you're using one of these reserved words. So what you can do is, if you have this indicator and you open it up the way I just showed you, go to File, Save As, create a new thing called 52-week low, and then you want to change this to low 52-week. If I hit F3, look what happens. Boom. You're going to see now that this entire thing reversed, and now we're going to see stocks near the lows. See, so I'm going to put it back the way it was, because that's how it is to me. But that's how you can work with it and see some of the ways to use easy language. This snapback in Ulta is really interesting. I was watching this, and I'll tell you, this was one that was a classic use of some of my tools. And let me just quickly explain that, because I should actually do this. Made a 52-week high here on the 13th, and then it pulled back. So this indicator, day since 52-week high or low. Let's look for things that have made highs in the last month, which is 21 calendar days. We'll go down here and we will go to data, insert label row. Boom. All right. Now everything above this label row made a 52-week high in the last, in the trailing 21 sessions. Now, if we just sort by 5-day, it's going to show us pullbacks. Boom, boom. So these are, some of these are pulling back in ways where there's not much of a signal in the near term. But Ulta would have come up using that signal right there. It would have made the high and it would have had that pullback, because that 5-day is basically the 1-week pullback. There's a way to look for these sort of pullbacks and rallies. Wait, one other name that was actually on my list recently was Monster Beverage. It's interesting how it's consolidating above this level. But again, no, very likely there's no real rush on this. I'm looking down my list here. I don't know if I have anything else I really want to mention. I have seen very little at the individual stock level. The real things to me have been these big moves in the Chinese names, some of the precious metals, and housing. Those are the things that have been popping up to me that are kind of most evident. There was one other actually that came up, which was AbbVie. This one yesterday popped up for me. I can't remember what indicator I saw, but this is also one that I'm kind of watching and trying to figure out what's happening with it. Again, above the 50-day. It's above the 21-day moving average, kind of this tight range here. This is one I want to look at and see if there's anything else really happening in it. And the last thing I'll just mention is if we look at things like Advanced Micro, the big popular names everyone likes, there's just nothing really in them right now. There's no kinds of clear Meta. I mean, Meta is a place where people have had a little bit of optimism toward it. But when you look at a chart like this, you're at the top of the Keltner channel, you're pretty much back to that gap. Hard to be overly sort of optimistic about anything like this. So I think we're still in a spot here where the big sort of the big NASDAQ names, there's not much relative strength in them. But what's interesting is that when you look at a name like Apple, I mean, if the market wants to rally, it wouldn't be hard to see Apple, go back toward 135. So I think the thing that's important to realize is just because these things have gotten mauled doesn't mean that the next move is lower. There's a reason here to see the potential for some kind of rebound. But the point is, not making any predictions, but if the market moves higher from here, Apple can go to 135, and then it has all kinds of resistance. But then if you look at a name like Starbucks, names like Starbucks, Oracle, these at this point could potentially have kind of more upside because they're above the 50-day moving average. So that's the main things I wanted to cover with you guys. So it's great to talk to everyone. I will be doing, like I said, the next event I'm going to be doing is going to be, actually I have a masterclass on the 18th, and then I'm doing Art of Trade Station later that day. So January 18th will be the next day I see you guys. Hope everyone has a great day. And don't forget, you can email me at drusselltradestation.com. I'll try and give you the zips. And take care. See you soon.